Have you ever wondered what people mean by the stock market? It sounds big and scary, but it is no. Think of it like a busy shop for pieces of companies. Long ago, people started businesses with their own money. Soon, they needed more money to grow, so they asked other people to help. In return, they gave small pieces of the business. These small pieces are called stocks. Owning a stock means owning a tiny part of a company. It is like sharing a pizza with many friends. Each friend gets one slice. The whole pizza is the company. The stock market is a place to trade these slices. People buy and sell stocks every day. This happens on computers, not in a street market. Imagine a big online meeting place. Buyers and sellers meet there. They agree on prices for stocks. Prices go up and down all the time. Why does this happen? Prices change based on how people feel. If a company does well, more people want its stock. When many people want something, the price goes up. Like toys before a holiday. If a company does badly, people worry. Then fewer people want its stock, so the price goes down. This is called supply and demand. It happens in daily life too. Think about buying fruit at a market. Fresh fruit costs more. Old fruit costs less. Stock market works in a similar way. Companies sell products and services. People watch how well they do. News also affects stock prices. Good news can lift prices. Bad news can drop prices. Many ordinary people invest in stocks. Teachers, drivers, shop workers, and parents. They hope their money grows over time. This money can help with future needs, like school fees or retirement. But the stock market is not magic. Prices can rise and fall. Sometimes people earn money. Sometimes they lose money. That is why people must be careful. Many people buy stocks for a long time. They wait patiently. Over years, good companies often grow. As they grow, stock prices may rise. This helps investors slowly build wealth. The stock market also helps companies. It gives them money to grow. They can hire workers. They can make better products. This affects everyday life. More jobs mean more income for families. Better products make life easier. Big markets have rules. These rules try to keep things fair. They protect buyers and sellers. Without rules, trust would break. Trust is very important. When people trust the market, they join it. When trust is lost, people leave. That also changes prices, so feelings matter a lot. Hope, fear, and confidence move markets. This is why markets can change fast, even in one single day. Still, the basic idea stays simple. People share ownership in companies. They trade that ownership with others. Prices change based on demand. Daily life events affect decisions. Everyone reacts in their own way. The stock market connects people and businesses. It links money, work, and growth. It is not only for rich people. It touches many normal lives. What people buy matters. What companies do matters. Small choices can have big effects. That is why people keep learning about it. Learning helps people make better choices. Understanding removes fear. Simple ideas become clear over time. The stock market is one of those ideas. It is not a game. It is part of the real world. It grows with people and businesses. It changes as the world changes. Yet its heart stays the same. Sharing, trusting, and trading value. Now you know the basics. No hard words, no fear. Just a simple story of how it works. And this is only the beginning. Now, let us continue the story and understand what happens after someone buys a stock. When you buy a stock, you become a small owner of that company. You do not go to the office or give orders to workers. You are just quietly sharing in the company's success or failure. If the company makes money, good things may happen to owners. Sometimes, the company gives some money back to its owners. This shared money is called a dividend. Think of it like parents sharing sweets with their children. Not every company gives dividends. Some companies keep the money to grow bigger and stronger. They may build new buildings or make better products. People choose stocks based on what they want. Some people want regular small income. Others want to wait and grow their money slowly. To buy stocks, people usually use an app or website. These apps are run by helpers called brokers. Brokers help connect buyers and sellers. They make sure trades happen safely and fairly. When you place an order, it goes to the stock market. If someone agrees to your price, the trade happens. This process is very fast today. Often it takes only a few seconds. Stock markets open and close at fixed times. They do not run all day and night. This gives people time to think and rest. Different countries have different stock markets. Each market follows its own clock. Some markets are very large and busy. Others are small and quiet. But all markets work on the same idea. Many stocks together form something called an index. An index shows how the market is doing overall. It is like a report card for the market. When many companies do well, the index goes up. When many do poorly, the index goes down. News often talks about these indexes. They help people understand the market mood. But one bad day does not mean everything is bad. Markets move up and down naturally. This movement is normal and expected. That is why patience is very important. People who panic often make poor choices. People who stay calm often do better. Many investors buy small amounts over time. They do not rush or try to get rich fast. This slow approach reduces stress. It also reduces risk over long periods. Risk means the chance of losing money. Every investment has some risk. Learning helps reduce that risk. People study companies before buying. They look at how the company earns money. They see how it treats customers and workers. Good companies build trust over time. Trust attracts more investors. Still, emotions play a big role. Fear can make people sell too fast. Excitement can make people buy without thinking. This is why prices move so often. Smart investors control their emotions. They focus on long-term goals. They do not chase quick wins. The stock market is not a lottery. It rewards planning, learning, and patience. It also reflects real life and real businesses. Governments watch markets carefully. They make rules to protect people. These rules stop cheating and lies. Rules help keep the market fair. Fair markets build trust. Without trust, people stop investing, so trust is very important. Over time, new companies join the market. Old companies may leave. This keeps the market fresh and active. Technology has changed how trading works, but the basic idea stays the same. People share ownership in businesses. Their choices shape the market. Every buyer and seller matters. Together, they create movement. The market reflects human behavior: hope, fear, patience, and learning. Understanding the market builds confidence. Confidence helps people make better choices. Better choices lead to better results. The stock market is a long journey. It rewards time and discipline. It teaches patience and balance. It shows how money and life connect. Money is a tool, not a goal. The market is a system, not magic. Learning the system removes fear. Fear fades when things make sense. Simple ideas become clear with time. The stock market is one of those ideas. It grows with people and businesses. It changes as the world changes, but its core idea stays simple: people sharing, trading, and trusting value.